Well, this is a little problem about the accounting equation. It's not really too in-depth, but it's worth learning a little bit about it. What we've got here is the instructions, and it says that these people each contributed $49,000 cash to start the business, and they received 4,000 shares of stock. So I'm saying each received 4,000 shares. Not really important. We don't need to know the number of shares in this chapter. One day we will. First year of operations ended December 31st, 2020. And here were the financial items that they had. Cash on hand and in the bank, $47,500. Amounts due from customers, $26,900. Equipment, $48,000. Amounts owed to publishers, $8,000. And then notes payable, 1 year notes payable at a local bank, $28.50. No dividends were declared or paid. So let's think about this. At the end of the year, we have cash of $47,500. We had, let's see, we have amounts due from customers, $26,900. That would be accounts receivable. And that anytime we are buying and selling, and we're going to be using accounts receivable and accounts payable. Usually due at the end of the month. Something like that. $26,900. The next thing we have is equipment, $48,000. Equipment is different from inventory and from supplies. Inventory is our stock in trade, what we're trying to sell to other people. Supplies are incidental things that we use in the course of the business, but we don't intend to sell them. Equipment are assets that we have that are going to last for more than one business cycle, more than 1 year, and they usually have pretty high value. Not all the time, but most of the time they do. And we depreciate those over the life of the equipment, over the estimated life of the equipment, and that depreciation just allocates the cost over the life that we expect them to have. Amounts owed to publishers, that's going to be accounts payable. $8,000. 1 year note, 1 year bank notes payable, so notes payable, $2,850. So let's think about this thing. Let's see what we got. This is an asset. Cash is an asset. Accounts receivable, another asset. Equipment is an asset. Accounts payable is a liability. And this is also, notes payable is also a liability. So let's take these guys and move them over to the other column here. Let's just add them up, because we know assets should equal liability plus equity. I'm going to leave myself a little room here. Where am I at? There we go. And we'll just add these guys up. And obviously this is not going to work, not going to balance. The difference that we are off, that we don't balance by, is $111,550. So we have to think about what caused that difference. Why, I've got all the things recorded they have here, but we've forgotten to record any equity at all. So let's think about equity, common stock. Common stock is contributed equity, equity that someone has invested in, has given to the company as an investment, and they've received some form of ownership, in this case common stock. It says they each contributed $49,000 to the company. There we go, 49,000. So 49,000 times 2. Or $98,000. Now if we take our little equation here, update it, we're off by $13,550. And so what we have to remember, what are the things that change capital from 1 year to the next, or from one business period to the next? First, it's common stock. So the thing that could change that, or let's do increase. So we could increase it by issuing stock, or you could decrease it by purchasing our own stock. This is not purchasing stock on the market. Oh, well, it is. It's not purchasing stock in another company. It's purchasing our own stock in order to decrease the number of shares outstanding so that the investors will receive more of a return whenever we give them a dividend. That's one of the reasons you might buy your own stock back. So if we issue common stock, that increases it. And if you decrease common stock, that will, of course, if you buy it back, that will decrease it. None of that happened. The other thing that happens is dividends. There is no way that dividends increase equity. Declaring and paying dividends decrease equity. In fact, in an accounting world, just thinking about the way this works, declaring the dividend reduces the equity. But that's for a later chapter, a much later chapter. But dividends, anytime we have dividends involved, and this few chapters here, we're going to think of it as declared and paid. So we're safe on that one. Dividends, anytime you have dividends, you're actually taking the earnings that the company has had, and you're sharing some of it back with the owners. It is not an expense. And let me say, I think I did this in class, dividends are not an expense. Important to remember that. So just remember, dividends are not an expense. The other thing that might change this is revenues. Revenues is money that we earned. So whenever we earn revenues, that increases our equity. We can't bring in revenues and decrease equity, so it has to be a positive here. And the other thing that changes equity is expenses. Expenses decrease equity. So in this case, if we look up here, we haven't issued any more common stock. We haven't declared any dividends. The only thing we have earned revenues and incurred expenses. And so, if you go to T accounts, if you remember looking in the book and finding and understanding about T accounts, they show the balance in an account by having whether it's a left-handed balance or a right-handed balance. Liabilities have a right-handed balance or a credit balance. So does common stock and revenues. Dividends have a debit balance. Expenses have a debit balance. And assets have a debit balance. Now all these guys are in the equity section of the balance sheet, even though some of them have debit balances. So we have this account called retained earnings. Retained earnings is an account where we bring in the amounts that we've earned less any dividends. So we would have I tried to capitalize that twice and never got it. Let's try it now. So we earn revenues here, and we don't know how much we've earned in revenues, and we don't know how much we've incurred in expenses. We know the dividends are zero. There's no dividends. That's what it said up here. No dividends. No dividends were declared or paid. So we're good with dividends. But what we know is the definition of net income is revenues minus expenses. And so we know that our revenues minus expenses. Oh, this is not going to work. Minus expenses equal net income. And so the difference, we know that dividends didn't change anything. We know that common stock didn't change. But we know that we're $13,550 off. So the difference between revenues and expenses for this year must be $13,500. So we have, well, let's just say it's $100,000 just for the fun of it. $100,000 in revenue. And the expenses, in order to have a net income of $13,550, would have to be $86,450. 100,000 minus $86,450 would give me a net income of $13,550. So if we do that, let's just try it. There you go. Our revenues minus our expenses equal $13,550. I don't know what these two numbers are. I don't know what they are. I just know that their difference has to be $13,550. So what we do at the end of a period is we go ahead and reduce revenues by, by the amount of the whole balance. We did what's called closing the account. So now I have a zero balance, and that this left-handed entry here, debit, has to go into retained earnings. And we close expenses the same way. And so we end up with a zero balance in expenses. And this entry we make here, goes over on the opposite side on retained earnings. And so my balance in retained earnings is, let's try again, 13,550. And that's what I've got over here. Now my assets equals the sum of my liabilities and my equity, my stockholders' equity. And that would give us a balanced balance sheet. A couple of things to note. Assets are always listed in order of liquidity. That liquidity means easy to spend, or easy to convert into cash, actually. So cash is the most liquid asset. And between these other two, accounts receivable and equipment, accounts receivable is much easier to convert into cash than equipment. It takes a long time to sell a building or a piece of equipment sometimes. Accounts receivable should be turned into cash within about 30 days. Accounts payable should be turned into cash within 30 days as well. These are notes payable that are 1-year notes payable, so we're assuming that they won't be turned into cash for about a year. So most liquid, less liquid, least liquid. Most liquid, less liquid. In equity, it would always be listed as common stock and retained earnings. Dividends, expenses, and revenues will never show up on a balance sheet. They are temporary accounts. So the difference between revenues and expenses and any dividends that have been paid out all get rolled up into retained earnings. And that retained earnings is the permanent account that stays on the books. Revenues, expenses, and dividends are temporary accounts. They get closed, turned into zero, and their balances get pushed up into retained earnings, and that shows up on the balance sheet. Next thing to remember is that we always do financial statements in a certain order. We start with the income statement. We list our revenues and our expenses, and we come up with net income. After we do that statement, then we do a statement that's called a statement of retained earnings. We start with our beginning retained earnings. In this case, it was 0 because we had no retained earnings to start with new company. We add our net income to it, $13,550, and we subtract from it any dividends that we had. So add our net income, which is what we've done here, and then subtract from it if we had any dividends. We would have dividends over here on this side. We didn't have any dividends. So income statement, retained earnings statement, balance sheet. And then finally, after we get that done, we have what's called a statement of cash flow, or a cash flow statement.